Let me ask you, what is your expectation with regard to, one, premiums inflation, and two, increased claims, because we know that Hong Kong and some other parts of Asia are still going through the waves and are experiencing higher unnatural deaths at this time?
Yeah, the bulk of the deaths, the mortality we saw in the COVID claims were disproportionately in the second half of last year for us in India and Indonesia. But across the region, we paid over 100,000 COVID claims last year, and that pretty much normalized the experience we'd had from the lower other types of medical claims, if you will. But it also is what you're supposed to do as an insurer. You're supposed to be there when people need you, and you're supposed to have impact, when things are tragic. So I think it's an example. But to put it in context, we're at 18.6 million clients in Asia. So we obviously our solvency's never been better. We're at 408 on the local solvency metric, which is an incredibly strong number. We've never had more central liquidity. We've never we did both the equity raise at $2.5 billion in Hong Kong, and we restructured our debt in December and January this year. So from a resilience point of view, we're fine. And we price, as an insurer, you price these risks into the market, and I think as an insurer, you're there for the customer when these tragic events occur. And so all that's doing what you'd think it would do.
Karen was asking you about the broader market outlook at the beginning of the interview. I think it's just worth circling back to where we may be going on interest rates, given how sensitive the business is largely to those key interest rate levels. What is your expectation? Do you think the geopolitical crisis we're having now in Europe is ultimately going to lead to lower rates globally?
No, I don't. I think it's market by market. I think it's more likely to lead to more inflation and just more volatility, as we've seen. We've never been less sensitive to rates and equity, and those metrics are published. But that's because 83% of our fee stream comes from health and protection or just fees in general, and those aren't economically sensitive to rate or markets. Rising interest rates are generally good for insurers, and both from an accounting point of view and a real economic point of view. So we benefit from that, but it's not a risk to us. I do think country by country, you will see, if a sovereign's triple B, it's not going to see a flight to quality. And so I don't think you'll see a consistent behavior of risk off, in all of our markets. Some of our markets are relatively young emerging markets, and some of them are very mature, sophisticated markets. But growth will be hard to find, without question. I think we've got a good footprint on where growth will be globally, and I think that's going to be one of the things investors look for is what markets are more resilient, what markets are growing, and what businesses are more resilient. I think that lens will change from stretching for maximum yield or maximum total return.